So over the years, the 18-year property cycle has gotten a lot of attention for allegedly being able to predict property price movements. But what exactly is it? Can we actually tell where we are in the property cycle? And also, can that tell us how we can take advantage of it? Hey everybody, welcome back to the channel. My name is Aaron, aka The Anxious Investor, and today we're going to discover everything you should know about the 18-year property cycle. And do make sure that you stay until the end, because today you're going to discover if this 18-year property cycle can benefit you on your property investing journey. Now, whether or not you own any property or properties, this can help you determine whether you should be paying closer attention to this cycle. And similarly, even if you're thinking about investing and you don't have properties yet, you'll want to know firstly if the cycle is real, and secondly if it's applicable to today's market, and most importantly if you can profit from it. So with that, let's get started. Now, Fred Harrison became famous for foreseeing the financial crisis in 2007 and 2008 from as early as 1998. In fact, in 2005, he published a book called Boom and Bust, which claimed that the UK property market cycle follows an 18-year-old cycle. And Harrison backed up this claim by demonstrating how the 18-year cycle had recurred across 200 years of UK house price data. And again, it was backed up by crashes in 53 to 54, 71 to 72, and 89 to 90, all of the claims that he made. Now, according to the theory, the property market would generally be in a slump for 3 to 4 years after the crash. For many, this is a great opportunity, but at the same time, lenders and investors do tend to leave the market, and the demand for real estate property tends to dry up, leaving an excess of supply causing property prices to fall. But then post this period, we have what we generally refer to as the recovery period, where we begin to see an increase in the overall confidence gradually returning and prices gradually rising for the next 6 to 7 years. And then we have a breather. Following the recovery phase, there is a brief market correction during which prices take a breather. And this usually lasts between 1 and 2 years and occurs when investors become concerned about the growth of the long-term durability before moving back into the final stage of this 18-year-old cycle, the boom phase. Now, the boom phase is where the demand is fueled by government stimulus and low financing requirements, and where supply is generally failing to keep up with the demand. It's a little bit like we've seen in the last probably 2 years, and this normally lasts 5 to 6 years, where substantial house prices and rental prices start to increase. And with that, the next cycle begins. So a question that may have sprung to your mind for many of you watching this right now and still with me is, why is there a property cycle? So the dynamics of supply and demand keep prices roughly in balance in almost every single market other than land. Now, whether it's for things like vehicles or labor for professions like barbers and hairdressers, for example, a slightly random example, but bear with me, I think I can make sense of it. Land always seems to be the anomaly. You see, it will be impossible to get an appointment, let's say for a hairdresser or a barber, every day if we suddenly became more vain and we want to look fresh all of the time. Barbers would simply raise their fees to profit from those desperate to spend more looking fresh all of the time. But obviously with that, the higher pricing in the hairdressing industry would then attract more hairdressers to instantly come into the market. But the larger increase of supply of barbers would then force everyone to lower their rates again in order to stay competitive, as people would just opt for better priced barbers. And alongside this, people may also not want their hair cut by someone who's just come into the market and go for someone with more experience. But nonetheless, the key point behind this example is that supply and demand work very close to keep costs consistent over a period of time. Except of course when it comes to land, for the most obvious reason that the amount of land available is fixed. You can't merely create more land if demand simply rises for it. There is just a certain amount of land and nobody's building any more. So as a result of this, as the economy expands, there is a need for additional homes, shops, factories, and as a consequence of this, prices will rise. And as many of you are aware, land prices rise faster than wages and the cost of commodities, because there is a supply mechanism to keep the prices down. Now, something I think that is worth mentioning is Ricardos' law of rent, which explains why rents are becoming larger over time. Now, it doesn't take long for individuals to notice what's going on and realize that investing in real estate will provide them with the best return on their investment. People often speculate by purchasing property at times when demand is very high, assuming that prices will continue to rise. However, because property prices rise faster than wages, the majority of people will soon be unable to buy them. And as a result of this, when this happens, the property bubble will burst, generating havoc for the banks, which have obviously been lending money secured against high-priced properties, forcing some of them to even leave the market. And banks then suspend lending, construction activity halts, and firms end up closing, all of which have obvious ramifications for the stock markets and of course employment levels too. Importantly, each cycle begins with a higher bottom than the previous one, implying that the long-term trend is always upwards, despite the extreme volatility that we see throughout the cycle. Now, one thing to note is prices eventually will fall back to a more reasonable level, and life returns to some normality, at which time the cycle begins all over again. So that, my good friends, is the property cycle in a nutshell. And before I speak about how you can profit from the cycle, if you made it this far, smashing that like button will massively help this video and channel, and I'd be extremely grateful if you could spare a few seconds just to do so. Having discovered that the property cycle is cyclical, and we've now kind of examined some of the stages that it passes through during each cycle, let's now talk about how it can benefit you. Because yes, all of this is fascinating, but how can we put it to better use in terms of our own investments? The first assumption is that we know that property is cyclical. Prices increase and decrease. And if you only listen to what the media says, the message is always everything's either fantastic or everything is horrible. And as emotional creatures, we often tend to miss out massively on the opportunities. You see, when we should probably be a little bit more conservative, we often get a little overexcited. And when we shouldn't be as fearful as we should be, or as the media tries to make us, we rarely pull the trigger on property purchasing. Hence why one of the main things I always try and teach on this channel is to go with logic over emotion. Let's not let emotion ever dictate the way that we invest. And now the second assumption, which I think is really important too, is that you can forecast what will happen next if the cycle goes reliably through its stages. You see, even if you don't know when something will arrive exactly, knowing that it will arrive gives you some reassurance and makes a significant difference. For example, if you know that prices won't stay low indefinitely, you're less inclined to panic and sell at the bottom of the market, and you're more likely to hold out for a better, more likely tomorrow. And again, it's reassuring that Fred Harrison's claims evidence all the way back hundreds and hundreds of years for the cycle's average duration coming in at around 18 years. But again, it's best not to get caught up in the intricate details of that cycle. Yes, the average age of the property cycle is 18 years, but remember, it could be a few years off in either direction. And remember, this time we have just been through a pandemic. But the main point is, if you can watch the stages progressing, even if you don't know how many exact years it's going to be, then the property cycle does get quite predictable, and you may be able to predict where your portfolio is going to sit in the next few years. For instance, are you seeing more and more cranes as you walk down the street, and prices seem to be taking a slight dip after a few years of slow and steady growth? If so, then you might deduce that, well, we're kind of hitting a recovery period, and you can brace yourself for the upcoming of an explosive phase, for example. You see, throughout the cycle, we've also seen how the smart money and the amateur investors behave completely differently. For example, as an ordinary investor lines up a large mortgage to get a piece of the boom, which is what we've seen recently, those in the know are covertly selling their stock and hoarding cash in preparation for an inevitable fall. To put it this way, most people purchase high and sell cheap, which is the exact opposite of what they should be doing. That's not how we want to be investing, especially if you watch this channel. Now, before I close this video, let's have a look at where we currently are. The property market should have reached its boom around 2021-2022 if the 18-year-old cycle is right. Now remember, we can be off a few years. However, surprisingly, this corresponds to the rapid rise in house prices we've seen since the pandemic started. There are undoubtedly signs of boom phase, with property prices up 8.6% in the last year. And the government plans to incentivize the housing sector a lot more, as we've seen, with credit easily available in the form of 95% mortgages in some cases, and interest rates are obviously low. Now, one thing that was quite interesting is I've seen investors claim that they could see prices rise for another 3 to 4 years, with some predicting crazy expectations that it could go up by another 25%. I don't really agree with that. But one thing I will say is we're not living in ordinary times. A coronavirus is one in a century event. And as Harrison acknowledges, such occurrences can disrupt the cycle, just as we saw with the First and Second World Wars. But one thing I will say is there is gotta be a limit to how much property prices rise while earnings remain the same. With my property update videos, I have mentioned furlough and stamp duty, holidays ending, and how these will cause a shift in the prices. And as a result, depending on your convictions, it may be prudent to prepare for the worst, while of course hoping for the best. And the main takeaway is that a crash is, in my opinion, unavoidable. Prices will fall at some point during your term as a property investor if you're in this for the long run, but they will also rise again too. And I hope for all your sakes, you all make a hell of a lot of profit and make the right decisions. And with that, my amazing friends who managed to stay until the end, that is all for today's video. If you discovered something new today, please share your thoughts in the comment section below, or add anything I may have missed to help others too. But sincerely, I thank you from the bottom of my heart if you managed to stick around to the end of this video when you could have been doing anything, but you chose to spend a few moments with me, which makes you pretty awesome, and I'm very grateful for that. So until next time guys, have an awesome day.